I'm Ian Cunningham, 43 years old, with a 15-year professional track record specializing in commercial real estate investment and development. As the managing partner of Cunningham Whitman Ventures, my role encompasses the oversight of every critical facet of our business operations: contract negotiations, financial structuring, risk assessments, and ultimately ensuring our investments perform at the highest level. This isn't just a business for me, it's a discipline built on rigorous process, meticulous documentation, and an unwavering commitment to ethical standards. Over the years, I have developed a reputation within the industry for thoroughness and reliability, and I take pride in safeguarding both our assets and our partners' trust. On what should have been a joyous occasion, my daughter Linda's wedding, I found myself confronted with an unexpected professional betrayal. While my focus was rightly on family, Douglas Whitman, my partner in Cunningham Whitman Ventures, executed a transaction involving the sale of a commercial property valued at $1.9 million. The catch: he forged my signature on the closing documents without my knowledge or consent. It was an action that struck at the very heart of our business relationship and the principles I uphold. The discovery came during the reception when I received a call from our title insurance contact, notifying me that the escrow account for the property sale had been frozen pending an investigation into the authenticity of the signatures on the documents. At first, the news felt surreal. How could this happen under my watch? Douglas, it turns out, had taken it upon himself to forge my signature and push forward a deal I had neither authorized nor been consulted about. His justification was blunt and telling. Time-sensitive deals require quick action. I remember responding with calm clarity. Family comes first anyway, consciously choosing to prioritize my daughter's milestone over immediate confrontation, while internally registering the severity of this breach. This incident was more than a mere lapse in communication. It was a calculated override of the controls and checks we had painstakingly established. Our partnership agreement included explicit clauses mandating joint consent on property dispositions exceeding $1 million, a safeguard designed to prevent exactly this kind of unilateral decision-making. Douglas's assumption that this protocol could be circumvented, or worse, that forged documents would slip past the title company's verification processes, revealed a significant miscalculation on his part. From a strategic standpoint, my initial response was to compartmentalize the emotional impact and pivot swiftly into professional assessment mode. I recognized that my approach needed to be methodical and grounded in documented facts. Emotional reactions, no matter how justified, have no place in high-stakes real estate disputes if the goal is to protect assets and reputations. Instead, I began mentally cataloging the documentation I would need: original signed contracts, notarized partnership agreements, email correspondence confirming transaction timelines, and considered how best to leverage these materials to challenge the fraudulent sale. At the wedding, surrounded by friends and family, I maintained a composed demeanor, understanding that personal and professional lines would soon intersect in complex ways. The breach of trust was profound, but I knew that strategic patience and detailed evidence gathering would be crucial. My focus shifted to assembling a comprehensive picture of the transaction, ensuring that every document was accounted for and that the contractual mechanisms we had built over the years could be activated to safeguard our mutual interests. This moment marked a clear inflection point, not just in the operation of Cunningham Whitman Ventures, but in how I would proceed to protect the business I helped build. It was a call to action, demanding not only legal acumen, but also a firm hand in partnership management. I resolved that this breach would be met with precise, procedural rigor rather than emotional reactions. The stakes were high, not just the $1.9 million property in question, but the integrity of our entire investment operation. As the managing partner, I bear responsibility for oversight and risk mitigation, and this incident underscored the importance of unyielding vigilance. Douglas's unilateral move had exposed vulnerabilities, but I was confident that the legal frameworks, combined with the title insurance safeguards and my exhaustive personal documentation, would provide the foundation for a strategic response. The days ahead would require me to act decisively, but always within the boundaries of professionalism and procedural correctness. For now, at the wedding, I chose to compartmentalize. Family celebrations first, strategic response second. But inside, I was already mapping out the steps needed to confront this betrayal systematically, turning documentation and contractual provisions into tools of professional justice. The title insurance company's intervention was a critical early sign, offering an opportunity to halt the transaction before any irrevocable damage occurred. It was a narrow window, and I intended to use it fully. This professional breach, revealed in such an unexpected setting, was a stark reminder that even long-standing partnerships require constant oversight, and that trust, while foundational, must be backed by enforceable controls. My role now was clear: to ensure that the integrity of Cunningham Whitman Ventures and the legacy I was building would not be compromised by one partner's recklessness or desperation. The journey ahead would demand every ounce of my expertise, discipline, and strategic patience. Over the course of my 15-year career in commercial real estate investment and development, I have meticulously cultivated a portfolio that currently generates approximately $12 million in annual revenue. This achievement didn't come by chance. It was the result of relentless attention to detail, disciplined contract management, and a proactive approach to risk mitigation. From the outset, I recognized that in an industry where multi-million-dollar deals hinge on precise legal documentation and nuanced negotiations, every signature, every clause, and every timeline matters decisively. My role as managing partner at Cunningham Whitman Ventures extends far beyond simply identifying promising properties. I oversee every contractual element, from initial terms and due diligence to closing protocols and post-sale audits. I personally draft, review, and archive all agreements, ensuring each document is notarized and compliant with jurisdictional regulations. I have developed a proprietary digital filing system that catalogs signed contracts, amendments, email correspondences, inspection reports, and financial statements. This archive is not merely a record, it's a strategic asset that allows me to track every facet of our transactions and to rapidly retrieve any document in moments of dispute or due diligence reviews. One of the pillars of our operational success lies in how rigorously we enforce our partnership agreements. Douglas and I established clear protocols requiring unanimous consent for any property disposition exceeding $1 million. These protocols were not arbitrary. They were designed to protect not only financial interests, but also the fiduciary integrity of our collaboration. Each decision, especially those involving high-value sales, undergoes multiple layers of review and approval, with executed consent documented across several formats: signed documents, time-stamped email confirmations, and recorded verbal approvals when necessary. This multifaceted approach serves as a bulwark against unauthorized actions and preserves transparency. Risk assessment and mitigation are embedded at every stage of our transactions. For example, when preparing closing statements or escrow instructions, I liaise directly with title insurance providers to ensure that every signature will be verified through advanced forensic analysis. Where applicable, I have cultivated professional relationships with key contacts at title companies, understanding their protocols and constraints. This knowledge enables me to anticipate potential vulnerabilities and to structure transactions that minimize exposure to fraud or error. My reputation in the industry rests on this foundation of thoroughness and ethical rigor. Over the years, I have earned the trust of lenders, investors, and legal counsel precisely because I deliver consistency and accountability. This reputation is not just a professional asset, but a strategic advantage that facilitates favorable financing terms and smooth transactional flows. It also means that any deviation from our established process, especially those undertaken unilaterally, raises immediate red flags. Douglas's actions, therefore, struck at the very core of the systems I had painstakingly built. His decision to forge my signature was not only a breach of trust, but a reckless gamble that overlooked the layered safeguards embedded in our operations. He underestimated how deeply our contracts were documented and how robustly our title insurance procedures would defend against such forgery. The comprehensive archives I maintained would serve as a critical tool to expose his unilateral maneuver. From a strategic perspective, this incident underscored the vital importance of maintaining exhaustive records and enforcing contractual discipline. It reaffirmed that in high-stakes real estate investments, professional competence is demonstrated not just in identifying opportunities, but in safeguarding every step of the transactional process. The detailed contract templates I developed include explicit remedies for breach of fiduciary duty and unauthorized transactions. These provisions would soon form the backbone of the legal challenges to Douglas's forged sale. It is also worth noting that this level of documentation demands continuous investment in administrative systems and staff training. I oversee a small team dedicated to contract management and compliance, ensuring that all documents pass through rigorous quality control before execution. This team also coordinates periodic audits of partnership activities to detect anomalies proactively. These processes have proven instrumental in preserving our operational integrity amid a complex and fast-moving market. Ultimately, my expertise lies in combining legal precision, financial acumen, and strategic foresight. This incident was a painful reminder that even the most well-structured partnerships require vigilant oversight. I am confident that the very assets Douglas sought to exploit, our detailed notarized agreements, my digital contract archives, and the title insurance safeguards, will prove decisive in contesting the unauthorized sale. The coming steps would require methodical, evidence-based action supported by these professional foundations, and I was prepared to mobilize all of them to protect our business and reputation. Douglas Whitman, now 45, had always been the more impulsive side of our partnership, but rarely had I witnessed such a calculated risk as the one he took with this $1.9 million property sale. Pressured by mounting cash flow issues that he had been trying to conceal from me and our other stakeholders, Douglas decided to circumvent the protocols we painstakingly established over the years. His solution? Expedite the sale without my knowledge or consent, by forging my signature on the closing documents. It was a blatant breach of trust and an attempt to override the foundation of our partnership controls. From an operational standpoint, this move was reckless. Our partnership agreement was explicit. Any property sale exceeding $1 million required the unanimous consent of both managing partners. This clause was not just boilerplate language, it was a vital safeguard designed to prevent unilateral actions that could jeopardize our shared investments. Douglas's bypassing of this protocol was the first red flag, but what followed was an even more significant miscalculation on his part. Douglas evidently believed that the title insurance company would not scrutinize the signatures on the closing documents to a degree sufficient to detect forgery. This assumption reflected a fundamental misunderstanding of the modern due diligence procedures employed in high-value real estate transactions. It also underestimated the robustness of the title insurer's forensic signature verification processes, protocols I had personally advocated for in our dealings to mitigate risks of fraud. The title company to which we entrusted our transactions employs advanced forensic analysis tools, including signature comparison algorithms and handwriting expert reviews. These methods go beyond cursory visual checks. They analyze pressure points, stroke order, and ink flow patterns to authenticate signatures. Douglas seemed unaware or dismissive of this level of verification, an ignorance that would soon become pivotal in unraveling his scheme. Additionally, there is the matter of timing and communication. Our agreed transaction timelines and mandatory approval steps are documented meticulously in our email exchanges and recorded meetings. Douglas's unilateral action sidestepped all these checkpoints. He forged my signature while I was indisposed at my daughter's wedding, timing the move to exploit my physical and procedural absence. The strategic error here was relying on the assumption that temporary absence equates to permanent consent. That is never the case in regulated real estate operations, nor should it be. In essence, Douglas attempted to weaponize the very protocols and trust that we built into our partnership against me. He gambled that speed could triumph over process, that forging a signature would be sufficient to close the deal before anyone noticed. Yet this gambit ignored the layered legal and operational controls we had implemented to prevent such abuse. For example, all property disposition documents must be reviewed by our compliance team and entered into our secure digital document management system, which logs user access and timestamps every file modification. This audit trail does not lie, Moreover, Douglas's plan failed to account for the notarization requirements embedded in our sales protocol. Every significant transaction requires notarized signatures to be legally valid. Forgery, therefore, was not merely the act of replicating my signature. It was a criminal offense that could lead to severe legal consequences. I had personally notarized multiple original documents in this deal, and the forged papers presented by Douglas would eventually be compared against these to expose discrepancies. Another critical oversight was Douglas's underestimation of the title insurance investigator's role. Margaret Farrell, the investigator assigned to this escrow, is known in the industry for her meticulous approach and adherence to company protocols. Although unaware of the internal dynamics of our partnership, her forensic review processes would impose an independent check on the legitimacy of all signatures. Douglas's assumption that she would approve the forged documents was flawed. In my experience, such investigators rely heavily on cross-referencing signature samples from previous transactions, notarized originals, and even government-issued identification documents. They also coordinate with forensic handwriting experts when doubts arise. This multi-level verification system is designed to catch fraudulent activity, exactly like what Douglas attempted. Internally, I recognize that these systemic safeguards were our strongest leverage. Douglas's plan was short-sighted and lacked an appreciation for the operational reality of well-structured real estate transactions. His urgency-driven decision, likely motivated by his liquidity crisis, overlooked how deeply layered our risk mitigation procedures are. The sophistication of the title insurance company's verification process and our internal compliance framework would soon converge to reveal his misconduct. From a professional perspective, Douglas's forgery was not only a violation of our partnership contract, but also a violation of fiduciary duty and potentially criminal fraud. These infractions carry severe legal and financial repercussions that extend beyond our immediate dispute. For Douglas, the path he chose risked not only the loss of trust, but also significant damage to his personal reputation and future career prospects in the industry. This episode illuminated the critical importance of comprehensive contract clauses and procedural rigor in high-stakes commercial real estate. It underscored why no transaction, regardless of urgency or opportunity, should bypass the controls that protect partners and investors alike. The unilateral action Douglas took was a textbook example of how desperation can blind a professional to necessary protocols and the consequences of ignoring them. As I processed this betrayal, I mentally catalogued the specific contractual provisions Douglas had violated: the unanimous consent clause for sales over $1 million, the anti-forgery and fraud provisions, escrow instructions, and notarization requirements. Each of these would play a strategic role in constructing a robust legal challenge to the forged sale. I also considered how the title insurance company's investigative procedures would align with these contract terms, creating a procedural trap to halt the transaction. In summary, Douglas's decision to forge my signature was a reckless, ill-informed attempt to expedite a sale during a moment of personal distraction on my part. It exposed his misunderstanding of the contractual and regulatory frameworks governing our partnership and the title insurance safeguards. His actions revealed vulnerabilities, but also triggered the activation of multiple professional safeguards designed precisely to prevent unauthorized and fraudulent property dispositions. While the betrayal was personal, my response would be purely professional. I recognize that the complex network of contractual clauses, document archives, notarization requirements, and title insurance protocols were the tools I needed to methodically dismantle Douglas's gambit, protecting both our business interests and my professional reputation. The next steps would involve leveraging these mechanisms to initiate a formal challenge, but for now, I remained focused on gathering every piece of evidence that would underpin a systematic response. The call from the title company was brief, but unmistakably serious. The escrow account for the $1.9 million property sale was frozen due to discrepancies detected in the signatures on the closing documents. Hearing that, I immediately shifted gears from managing family celebrations back to the precise demands of my professional responsibilities. It was clear that the title insurer had uncovered something unusual, something that warranted halting the transaction before any funds changed hands. This was a crucial window of opportunity, one that could prevent irreparable financial loss if leveraged correctly. I began by retrieving the complete file for that transaction from our digital archives, accessing every document connected to the property sale. My first step was to review the notarized partnership agreement signed by Douglas and me, which I keep stored both digitally and as hard copies in a secured vault. This agreement explicitly outlines the requirement of dual consent for any property sale exceeding $1 million, a clause Douglas blatantly ignored. The agreement also details the legal obligations and fiduciary duties binding each partner, which formed the backbone of the case I was beginning to assemble. Next, I carefully examined the email threads between Douglas and our various contacts regarding this sale. These messages, time-stamped and securely archived, revealed no mention of me authorizing the deal. On the contrary, some emails indicated Douglas was pushing for a quick close, citing time-sensitive pressures, but conspicuously absent was any request for my approval or even a heads-up. This lack of communication was a clear breach of our partnership protocols, which require documented consent for all major transactions. Turning to the closing documents themselves, I compared the allegedly signed documents bearing my signature with the original contracts and signature samples I had on file. The differences were subtle but unmistakable to the trained eye. Pressure inconsistencies, stroke hesitations, and variations in ink flow all pointed toward forgery. Because I maintain a comprehensive record of all signed documents, complete with notarized originals and digital scans, I was able to conduct this forensic comparison quickly. My own signature, unlike the forged one, had consistent pressure distribution and flow patterns that only an original hand signature maintains. This was not sloppy work on Douglas's part, but it was clearly inauthentic. The escrow instructions were another critical piece I examined. These instructions, co-signed by both partners per our standard operating procedures, direct the title company on how to disburse funds and manage contingencies. In this case, the forged signature disrupted that process entirely. I confirmed that the instruction package sent to the title company lacked my genuine signature, violating both our internal controls and the escrow agent's standard protocols. All these findings pointed to multiple simultaneous violations: forgery, unauthorized sale, breach of fiduciary duty, and violation of escrow instructions. Importantly, none of these offenses were accidental or due to oversight. They were deliberate actions taken by Douglas to circumvent the safeguards we had established precisely to prevent such occurrences. I methodically cross-referenced each piece of evidence against our partnership agreement and the standard industry protocols. This step was critical to verify that every documented breach had a contractual or regulatory foundation for challenge. I also noted that the title insurance company's intervention was consistent with their fraud detection procedures, which employ forensic analysis rather than just visual inspections. The freezing of escrow funds was a procedural safeguard that gave me the breathing room needed to mount a professional response without immediate financial risk. Throughout this assessment, I maintained a deliberate, calm mindset, recognizing that emotional reactions, while understandable, would not serve the strategic objectives ahead. Instead, I focused on creating a detailed chronology of events, supported by irrefutable documentation. The goal was clear: to demonstrate unequivocally that the sale was unauthorized and fraudulent, thereby compelling the reversal of the transaction and protecting our asset. As I reviewed each document, I mentally catalogued the legal and operational levers embedded in our partnership agreement and supported by title insurance protocols. The notarized agreements, email trails, escrow instructions, and signature comparisons formed a cohesive evidentiary framework. This framework would enable me to assert our rights firmly and systematically. This was not merely an internal dispute, it was a professional challenge that threatened the financial health and reputation of Cunningham Whitman Ventures. Yet, the presence of robust documentation and the title insurance company's forensic processes offered a formidable advantage. The escrow freeze was a critical early victory. It prevented any premature transfer of funds and effectively paused the process, preserving our options. In that moment, I fully understood the importance of the discipline I had maintained over the years. The thorough contract management, the insistence on notarization, the digital archiving, the defined partnership clauses, all these elements converged to provide the structural integrity necessary to respond decisively to Douglas's breach. The path forward was clear. Assemble this evidence into a coherent, legally sound challenge, engage the right legal counsel, and leverage the title insurance company's findings to halt and reverse the sale. But for now, my assessment was that the transaction's unauthorized nature was evident, grounded in documented proof rather than conjecture. As the reception continued around me, I compartmentalized this discovery with professional resolve. The escrow freeze was a procedural safeguard that bought invaluable time, a strategic pivot point. I was already mapping out the steps to convert these findings into a formal challenge, knowing that the meticulous documentation would be the cornerstone of our defense and eventual recovery. The breach was serious, but so was our preparedness. The moment the call from the title company ended, I knew time was of the essence. The escrow freeze was a critical procedural pause, but it wouldn't last indefinitely. To ensure we capitalized on this opportunity, I immediately initiated the next phase, assembling a precise, chronological dossier of all relevant evidence. This was not a moment for haste driven by emotion, but for deliberate, systematic preparation. First, I contacted a real estate litigation attorney with a proven track record in handling partnership disputes and fraudulent transaction cases. The choice of legal counsel was strategic. I needed someone deeply familiar with commercial real estate contracts, fiduciary duty litigation, and title insurance claims. I arranged an emergency consultation for the next day to lay out the situation, emphasizing the urgency created by the escrow freeze and the potential financial exposure embedded in the $1.9 million property sale. While finalizing that appointment, I began organizing every piece of documentation I had regarding the transaction. Our proprietary digital contract management system became the central hub for gathering files. I exported complete PDFs of the notarized partnership agreements, documents that serve as the legal backbone of Cunningham Whitman Ventures. These agreements explicitly detailed the dual consent clause for sales exceeding $1 million, providing an immediate contractual violation to challenge Douglas's forged signature. Next, I compiled all email correspondence related to this property sale. This inbox thread was a revealing narrative in itself. It confirmed Douglas's unilateral push to expedite the deal without any formal communication to me. Time-stamped messages from Douglas to potential buyers and title agents clearly lacked my input or consent. Not only did these emails demonstrate the breach of protocol, but they also revealed Douglas's attempt to frame the urgency of the deal as a time-sensitive opportunity, a pretext for sidelining established consent procedures. Parallel to these efforts, I retrieved the scanned copies of the closing documents, specifically those containing the forged signature. These digital files included the original signed contracts I personally notarized, archived meticulously for every transaction over the past decade. Having these certified originals side by side with the suspect documents was essential for the forensic comparison process, which I knew the title insurance investigator would rely upon. I annotated the differences, particularly noting irregularities in stroke pressure and signature flow that were inconsistent with my authentic autograph. Additionally, I gathered escrow account statements and instructions submitted to the title company. Our standard operating procedure requires co-signatures on these documents to authorize fund disbursement and to ensure compliance with agreed-upon contingencies. The absence of my genuine signature in the escrow instructions represented another clear breach, not just of our partnership agreement, but of escrow agent guidelines, which require unequivocal partner authorization for disbursement of significant funds. Recognizing the complexity of the evidence, I created a detailed chronological timeline that linked each document, email, and contractual clause to corresponding dates and actions. This timeline was designed to present a compelling narrative to both legal counsel and the title insurance company, illustrating the sequence of unauthorized actions taken by Douglas. I formatted this timeline into a presentation package using clear headings and cross-references that would facilitate quick understanding during legal review and potential court proceedings. To strengthen our position, I reached out discreetly to colleagues and associates who had been aware of Douglas's recent financial difficulties. I requested written statements confirming conversations that suggested Douglas was under pressure, which could corroborate motives behind his reckless behavior. These personal testimonies, while not formal evidence, would add contextual weight to the breach of fiduciary duty claim. Throughout this process, I maintained rigorous digital backups of every file and communication, using encrypted storage to ensure data integrity and prevent any tampering. I also logged every interaction with Douglas and third parties regarding the sale, knowing that maintaining a meticulous record of communications would be invaluable in demonstrating my professional conduct and Douglas's evasiveness. Importantly, I kept the title insurance company's forensic verification process in mind. Douglas had underestimated the thoroughness of their protocols, an error I intended to exploit fully. The company's investigator, Margaret Farrell, had already identified discrepancies, and I anticipated her forensic handwriting analyst's reports would provide an independent expert confirmation of the forgery. I prepared to coordinate with Margaret by offering access to our notarized originals and archived documents, positioning ourselves as cooperative and transparent, which would further strengthen our credibility. In summary, this phase was about converting discovery into strategy. I wasn't reacting impulsively, but building a robust, evidence-based legal and professional case that could withstand scrutiny at every level, whether in court, regulatory investigations, or industry arbitration. Each piece of organized documentation served as a strategic lever to press for transaction reversal and to hold Douglas accountable under both contractual and fiduciary frameworks. As the wedding festivities continued around me, I compartmentalized this intense preparation, understanding that the coming days would demand both calm professionalism and relentless pursuit of justice. The escrow freeze was a narrow but decisive opportunity, and I was determined to mobilize all necessary resources, promptly and precisely, before any further unilateral actions could be attempted. This systematic approach was the only viable path to safeguarding the business and ensuring that controls we had established were not just words on paper, but enforceable realities. Once I engaged my real estate litigation attorney, the depth and gravity of Douglas's misconduct became even clearer through a detailed legal lens. At our initial meeting, I presented the full dossier, notarized partnership agreements, archived original signatures, the forged closing documents, email chains demonstrating Douglas's unilateral communications, escrow instructions lacking my real authorization, and the title insurance company's preliminary forensic findings. My attorney meticulously reviewed each piece, aligning it with relevant statutes and contractual provisions. From a legal standpoint, the most glaring violation was the forgery itself. Under state law, forging a signature on a real estate transaction constitutes criminal fraud, an intentional deception to secure unauthorized benefit. The forged documents were not just a breach of contract, but a prosecutable offense carrying potential felony charges. This elevated the stakes substantially, extending our response beyond civil remedies into possible criminal proceedings that could be leveraged to underscore the seriousness of Douglas's breach. Equally significant was the breach of the partnership agreement's unanimous consent clause for property dispositions over $1 million. This clause, a linchpin of our contractual safeguards, required both managing partners to provide explicit written consent before any sale could proceed. Douglas's unilateral execution of the sale violated this fundamental provision, rendering the transaction unauthorized and voidable. My attorney emphasized that this breach alone was sufficient grounds for rescission and damages under partnership law. Further exacerbating Douglas's position was his violation of escrow instructions established as standard operating procedure. Our mutual instruction to the escrow company mandated that fund disbursement required signatures from both partners, ensuring dual oversight over financial movements. The forged signature on these instructions invalidated the escrow's authority to release funds, providing a valid basis for the title company's freeze and a clear contractual breach. Compounding these violations was the breach of fiduciary duty inherent in Douglas's actions. As partners, Douglas and I had a legal and ethical obligation to act in the best interests of the partnership and each other. His secretive forgery and unauthorized sale constituted a clear conflict of interest and a failure to uphold these fiduciary responsibilities. This breach opened the door for claims not only of contract violation, but also equitable remedies, including damages for harm caused by his deceit and unilateral actions. The title insurance company's forensic signature verification report became a pivotal piece of evidence. Conducted by Margaret Farrell's team, the report applied advanced handwriting analysis techniques, examining pressure patterns, stroke order, and ink flow discrepancies, to definitively conclude that my signature on the closing documents was forged. This independent expert confirmation strengthened our claim dramatically, providing an objective third-party validation of the fraud. The report also documented discrepancies in the notarization stamps, further calling into question the authenticity of the closing package. Leveraging this forensic report was critical because it tied together the contractual breaches with incontrovertible proof of criminal acts. My attorney advised that presenting such expert evidence early in litigation not only bolsters credibility, but also pressures Douglas to reconsider settlement possibilities, given the weight of the evidence. Beyond the immediate violations, our legal strategy also identified Douglas's attempts to conceal his actions. Email chains revealed his efforts to obscure the lack of my consent by misrepresenting transaction timelines and withholding key communications. These concealment efforts could be argued to constitute additional fraudulent behavior, further undermining his defenses. As a result, we prepared a multi-pronged legal approach, filing a formal claim with the title insurance company, asserting the fraud, and requesting indemnification for any financial losses, initiating a civil lawsuit against Douglas seeking rescission of the sale, compensation for damages exceeding $1.9 million, and punitive damages for breach of fiduciary duty and fraud, and submitting formal complaints to regulatory agencies overseeing real estate practices and professional conduct. This comprehensive legal positioning aimed not only to reverse the unauthorized transaction, but also to impose professional and financial consequences on Douglas, deterring similar misconduct in the industry. Our evidence would also serve to protect our reputation with lenders, investors, and clients by demonstrating decisive and competent handling of the breach. Throughout this process, I remained focused on maintaining professional integrity, ensuring that every filing, correspondence, and legal argument was supported by thorough documentation and conducted within procedural norms. Emotional reactions have no place in such litigation. Instead, the strength lies in systematic evidence and precise application of legal principles. In conclusion, the legal analysis confirmed that Douglas's actions were multifaceted violations: criminal forgery, breach of contract, fiduciary duty violations, and escrow procedural breaches, all reinforced by expert forensic confirmation. Armed with this robust legal framework, we were positioned not only to halt the fraudulent sale, but also to pursue substantial remedies, sending a clear message about the consequences of such breaches in professional partnerships. The next steps would require coordinated legal filings and strategic communications with the title insurer and regulatory bodies, a process I was prepared to navigate with steady professionalism and firm resolve. With the evidence meticulously assembled and the legal framework firmly established, the next phase was clear. We needed to act decisively to protect Cunningham Whitman Ventures from any further unilateral actions by Douglas, and to ensure that the unauthorized sale was formally challenged within all applicable channels. I instructed my attorney to draft and send a detailed formal notification to the title company, explicitly requesting the continuation of the escrow freeze. This communication referenced the forensic findings already shared by Margaret Farrell's team, underlining the serious concerns about signature authenticity and breach of contract. The letter also insisted that no funds be disbursed from the escrow under any circumstances until the matter was fully resolved through legal and regulatory review. Simultaneously, we formally initiated civil proceedings against Douglas Whitman. The lawsuit, filed in the appropriate commercial court jurisdiction, was comprehensive. It sought rescission of the $1.9 million sale, damages for breach of fiduciary duty and fraud, and attorney fees. The complaint was carefully structured to reflect the chronological timeline of events and included exact citations from the notarized partnership agreement clauses Douglas had violated. Attached were key pieces of evidence: the signature comparison analyses, email correspondence demonstrating lack of consent, and the escrow instructions missing my genuine authorization. Filing suit was a strategic move designed to establish clear legal boundaries and to signal to all stakeholders, including lenders and clients, that we were pursuing remedial action through formal channels. Aware of the broader impact this dispute could have on existing and prospective relationships, I took the proactive step of alerting several key clients and lending institutions connected to Cunningham Whitman Ventures. Each communication was professional and factual, carefully phrased to maintain trust and transparency, without divulging unnecessary details that could prejudice ongoing negotiations or damage our reputation. I explained that a dispute over a property sale was underway and that the escrow freeze was a precautionary measure, safeguarding all parties' interests. I assured them that the situation was under control and that I was personally overseeing the resolution with legal counsel. Maintaining this open line of communication was critical to preserving confidence. In commercial real estate, reputation and reliability are paramount, and rumors or silence could invite damaging speculation. Throughout this period, Douglas remained either unaware or dismissive of the full scope of our response. While he continued to press informally for a quick resolution and closure of the sale, I responded only in writing, carefully documenting every interaction. His communications often included veiled threats or attempts at coercion, suggesting we settle amicably or avoid unnecessary litigation costs. I consistently declined these overtures, reinforcing the fact that any agreement would require full transparency, legal oversight, and acknowledgement of the underlying breaches. Every refusal and reply was logged and archived. Maintaining this record was essential to uphold procedural integrity and to demonstrate my commitment to a fair, rule-based process. Meanwhile, I coordinated closely with Margaret Farrell and her team at the title insurance company. I provided them with full access to our notarized originals and contract archives, facilitating their ongoing investigations. Their role as impartial forensic evaluators and procedural gatekeepers was invaluable. The title company's decision to maintain the escrow freeze was a significant procedural win. It effectively stalled any transfer of funds and prevented Douglas from benefiting financially from the forged transaction. This freeze was not indefinite, however, and it depended heavily on our continued cooperation and provision of evidence, which we prioritized. In addition, I worked with our internal compliance team to monitor all related partnership accounts and transactions closely. We instituted temporary holds on any discretionary fund movements linked to Douglas's authority, ensuring that no further unauthorized financial activities could occur. These internal controls, layered on top of external legal actions, served as a comprehensive safeguard for our partnership's financial stability. The professional atmosphere throughout these developments was deliberately restrained. I avoided any public accusations or emotive statements, focusing instead on clear, documented communication and methodical legal steps. This approach reinforced my credibility with all involved parties, clients, lenders, legal counsel, and the title insurer, by demonstrating that the matter was being handled with the utmost professionalism and respect for due process. In parallel, I began preparing for the longer-term implications of the dispute. I identified critical next steps, including potential regulatory complaints and arbitration options, and discussed these strategically with my legal team. We plan to use the mounting evidence and procedural advantages to consolidate our position and gradually increase pressure on Douglas to resolve the matter within the frameworks we controlled. As this phase of the response unfolded, the situation remained professionally precarious. Douglas's unilateral actions had triggered a cascade of consequences that froze a major transaction, alerted key stakeholders, and initiated legal proceedings. Yet, the full resolution was still ahead. My role was to maintain the course, firm but professional, systematic but patient, ensuring that every procedural action was documented and leveraged effectively. The escrow freeze and lawsuit were critical components in this ongoing strategy, setting the stage for the subsequent legal and operational developments that would ultimately test the resilience and integrity of Cunningham Whitman Ventures. Douglas immediately encountered significant operational hurdles once the escrow was frozen. The title company's decision to halt the disbursement of funds effectively stalled the entire closing process. This freeze sent a clear message to all parties involved. The transaction could not proceed until the authenticity of the signatures was conclusively verified. For Douglas, this represented a critical bottleneck, as the sale's completion was now dependent not on his unilateral actions, but on procedural compliance and external validation. Simultaneously, several key lenders who had been lined up to provide financing for this transaction swiftly reacted to the news. Loan officers and underwriters began to withhold approvals and pause funding commitments pending a full investigation. Given the scale of the deal, nearly $2 million in value, these lenders exercised considerable caution. Their decision to suspend funding was not only a prudent risk management measure, but also a reflection of the importance that financial institutions place on clear title and legitimate authorization in real estate deals. This meant Douglas's liquidity crunch remained unresolved, as anticipated capital inflows were effectively blocked. Compounding these financial setbacks, our client base and prospective investors started raising questions. Word travels quickly in real estate circles, and the sudden escrow freeze triggered concern and skepticism among long-standing clients and partners. Some reached out to me directly, seeking reassurance about the stability of Cunningham Whitman Ventures and the integrity of ongoing projects. I responded with transparent, measured communications, carefully balancing the need to maintain confidence without prematurely divulging sensitive details about the internal dispute. I reassured them that the escrow freeze was a protective measure in line with industry best practices, and that the partnership was actively engaging legal counsel to resolve the matter. Meanwhile, Douglas's attempts to resume control or push the transaction forward were met with growing resistance on multiple fronts. He made informal overtures suggesting we negotiate a way forward or settle the matter quickly, often accompanied by subtle pressure to avoid protracted legal involvement. Each of these proposals I professionally declined in writing, underscoring that any resolution would require full legal transparency and acknowledgement of the breach. All correspondence was meticulously logged and backed up, preserving a clear record of Douglas's responses, or at times evasions. This documentation would prove invaluable in any formal proceedings. The title insurance company intensified its investigation under Margaret Farrell's leadership. She requested comprehensive documentation, including notarized originals, email exchanges, and escrow instructions. We provided full cooperation, supplying our well-maintained archives and notarized contracts for forensic examination. The investigators' methodical approach lent additional credibility to our claims, as they applied sophisticated forensic handwriting analysis and signature verification techniques beyond the initial discrepancy detection. This level of scrutiny reinforced the procedural barrier that prevented Douglas from circumventing the system through forgery. From a risk mitigation perspective, the escrow freeze was a decisive containment measure. It prevented Douglas from authorizing disbursements or completing the sale, thereby preserving the property and associated assets within the partnership's control. I coordinated with our internal compliance team to monitor all accounts linked to the disputed property, ensuring no funds were moved without proper authorization. We also instituted temporary holds on any transfers connected to Douglas's authority, effectively neutralizing any attempts he might make to exploit access to partnership resources during the dispute. Operationally, the partnership's reputation was under strain, but I prioritized maintaining professionalism and transparency. I communicated regularly with lenders and clients, issuing factual updates that emphasized the procedural nature of the escrow freeze and the partnership's commitment to resolving the matter through appropriate legal channels. This approach helped to dampen rumors and stabilize confidence, which was critical given our reliance on ongoing client relationships and financing agreements. Despite these growing pressures, Douglas appeared increasingly cornered. His inability to move the sale forward, combined with the mounting scrutiny from title insurance and legal counsel, limited his maneuvering room. Yet he stubbornly persisted in informal attempts to bypass legal processes, often suggesting alternative arrangements that lacked formal documentation or failed to address the core issues of forgery and breach. My consistent refusal to entertain such proposals reinforced the message that the partnership would adhere strictly to contractual and legal standards. Throughout this phase, I maintained rigorous documentation of all interactions, from emails and phone calls to formal letters and meeting notes. This record-keeping was essential to demonstrate procedural integrity and to support potential claims of coercion or obstruction. It also underscored my commitment to handling the dispute with measured professionalism, avoiding any personal confrontations or emotional reactions that could undermine our legal position. At the same time, I remained in close contact with Margaret Farrell and the title insurance team, monitoring the progress of their investigation and preparing to respond promptly to any additional requests for information or documentation. Their continued cooperation was crucial to sustaining the escrow freeze and advancing the fraud claim process. In summary, the immediate consequences of Douglas's forged sale attempt were multifaceted. The escrow freeze halted the transaction, lenders suspended funding, and clients voiced concerns about deal credibility. These operational setbacks placed Douglas under significant pressure and validated the strategic importance of the title insurance company's forensic review. By maintaining professionalism in communication, relentlessly documenting interactions, and coordinating closely with legal counsel and title investigators, I positioned Cunningham Whitman Ventures to preserve its assets, protect its reputation, and build a compelling case for reversing the unauthorized sale. The situation remained precarious, with tensions rising as Douglas sought to regain control. But the structural safeguards we had established were effectively containing the breach and setting the stage for further legal action. With the lawsuit formally filed, the situation escalated into a full-fledged legal and regulatory confrontation. My attorney and I coordinated closely to ensure that every procedural step was executed with precision, mindful that any misstep could weaken our position or allow Douglas an opening for delay tactics. The complaint articulated clear claims of forgery, breach of the partnership agreement's unanimous consent clause, breach of fiduciary duty, and violation of escrow instructions. We attached detailed exhibits, including notarized partnership agreements, email correspondence evidencing lack of consent, and the title company's preliminary forensic findings to substantiate each allegation thoroughly. Simultaneously, we lodged formal regulatory complaints with the State Real Estate Commission and the financial oversight bodies governing real estate transactions. The objective was twofold: to trigger official investigations into Douglas's conduct and to create an additional layer of accountability beyond private litigation. These regulatory bodies have their own investigative powers, including subpoena authority and disciplinary protocols, which could lead to license suspension or revocation. We made sure the complaints clearly referenced the documented forgery, unauthorized sale, and fiduciary breaches, emphasizing the public interest in maintaining industry integrity. The title insurance company, under the leadership of Margaret Farrell, escalated its fraud claim process in parallel. Having already identified discrepancies during their initial forensic signature analysis, they commissioned independent handwriting experts to conduct a comprehensive examination. These specialists applied advanced techniques, measuring pen pressure, stroke rhythm, and microscopic ink distribution patterns, comparing the contested signature with a wide array of authenticated samples from my extensive archives. Their analysis conclusively confirmed that the signature on the closing documents was forged. The final forensic report was detailed and unambiguous, stating that the signature lacked the natural variation and pressure consistency characteristic of an authentic hand-signed mark. This expert validation was critical. It provided an impartial, scientific basis to support our legal claims and reinforced the title insurer's obligation to uphold the escrow freeze until resolution. We promptly shared this forensic report with our legal counsel and included it in the lawsuit exhibits. The weight of this evidence exerted significant pressure on Douglas's legal team, narrowing his options to either contest the findings with equally credible expert testimony or negotiate under highly unfavorable terms. Concurrently, the impact of these developments rippled through our client network. Several long-time clients had begun to distance themselves from joint projects involving Douglas. Their concerns centered on risk exposure and potential reputational damage from association with a partner under legal scrutiny. These withdrawals were professionally challenging but anticipated, given the stakes involved. I engaged directly with these clients, offering transparent updates framed around the procedural safeguards activated and our firm commitment to resolving the dispute responsibly. Maintaining these relationships required a careful balance, acknowledging their concerns without disclosing sensitive litigation details that could jeopardize ongoing negotiations. Douglas, facing mounting legal and reputational pressure, attempted to shift tactics. He initiated several last-minute settlement offers proposing to resolve the dispute quickly in exchange for limited concessions. These proposals, often delivered through informal channels, lacked substantive acknowledgement of wrongdoing and failed to address the core issues of forgery and breach of fiduciary duty. My counsel and I evaluated each offer carefully, recognizing that settling without full accountability would undermine the partnership's integrity and set a dangerous precedent. Therefore, every offer was professionally rejected, with written responses stating our terms clearly, full rescission of the sale, damages for losses incurred, and formal acknowledgement of contractual breaches. Alongside settlement negotiations, Douglas's legal team issued threats of countersuits and attempts to discredit the forensic evidence. Anticipating these tactics, my attorney prepared defensive strategies, including expert rebuttals and motions to exclude unreliable testimony. We also compiled additional corroborating evidence, such as witness statements from colleagues aware of Douglas's financial distress and documented attempts to conceal the transaction to fortify our case. The court responded swiftly to our filings, recognizing the urgent nature of the dispute and the risk of irreparable harm. Preliminary injunctions were granted, preventing Douglas from proceeding with the property sale and freezing his access to partnership funds. These orders effectively neutralized his ability to capitalize on the forged transaction or manipulate partnership resources during litigation. This judicial intervention underscored the strength of our evidentiary position and the seriousness with which the court regarded the alleged fraud. Throughout this period, I maintained a professional front in all interactions, whether with the court, title insurer, clients, or Douglas. Every communication was documented meticulously, preserving a transparent record that would support procedural integrity. I avoided personal confrontations or emotional responses, focusing instead on the legal and contractual issues at hand. This phase of the dispute marked a critical intensification of the conflict, with the legal, regulatory, and professional mechanisms converging to constrain Douglas's unilateral actions and safeguard Cunningham Whitman ventures. The forensic handwriting report in particular was a turning point, a scientific confirmation that transformed suspicion into actionable proof. The carefully coordinated filings and injunctions established a systematic trap that limited Douglas's maneuverability and protected the partnership's assets and reputation. As these processes unfolded, the environment remained professionally charged but controlled. The groundwork laid in these weeks positioned us to negotiate from strength, pursue remedies rigorously, and send a clear message about the consequences of breach and forgery in professional real estate partnerships. The next stages would involve sustained legal effort and strategic communication, but the foundation for eventual restitution was firmly in place. Douglas's professional standing began to unravel rapidly in the weeks following the formal lawsuit and title insurance fraud claim. The combination of mounting legal pressure and the public nature of the dispute severely eroded his credibility within our industry. Word traveled fast through the real estate community, and it wasn't long before colleagues, clients, and lenders started distancing themselves from him. The partnership between Douglas and me, Cunningham Whitman Ventures, was effectively dissolved as the trust that once underpinned our collaboration became irreparably broken. From a business perspective, the dissolution of the partnership was not just symbolic, but operationally critical. We had to initiate a formal process to separate our financial and legal interests, ensuring that Cunningham Whitman Ventures ceased operations jointly and that I assumed exclusive control of partnership assets not encumbered by the disputed $1.9 million property sale. This required meticulous review and renegotiation of all outstanding contracts, loan agreements, and investment commitments linked to Douglas's involvement. Simultaneously, the legal fees Douglas incurred began to escalate significantly. The complexity of litigating forgery, breach of fiduciary duty, and fraud claims meant that his legal counsel required extensive investigation, expert testimony, and motion practice. Court filings alone generated mounting costs, while defending against regulatory inquiries and the title insurance company's claim added further financial strain. Unlike me, Douglas lacked the extensive documentation and professional networks to streamline his defense, forcing him into reactive and costly legal tactics. The legal actions triggered a domino effect on Douglas's personal financial standing. Creditors began scrutinizing his personal assets, particularly as liens and judgments were filed in relation to damages sought in the lawsuit. Property titles, bank accounts, and investments tied to Douglas's name were subject to potential claims, effectively freezing or limiting his liquidity options. This financial pressure compounded his professional fallout, reducing his ability to negotiate or settle on favorable terms. Further investigations, partly instigated by regulatory bodies responding to our formal complaints, uncovered additional irregularities in Douglas's management of partnership resources. Audit trails revealed unauthorized expenditures, misallocation of funds, and inconsistent record-keeping. While these findings were secondary to the forged sale, they painted a broader picture of mismanagement and disregard for fiduciary duties. These revelations were circulated discreetly within industry circles through regulatory reports and informal networks, further damaging Douglas's standing. The negative publicity surrounding the dispute also gained traction in industry media outlets. Local real estate journals and online platforms published exposés highlighting the case as a cautionary tale about the risks of insufficient oversight in partnerships. These articles emphasized the importance of rigorous contract enforcement and title insurance safeguards, often citing our case as an exemplar of both the dangers of unilateral action and the effectiveness of professional diligence. The media coverage amplified the reputational damage Douglas faced and served as a warning to others in the field. Douglas's personal life was not immune to the fallout. The stress and financial strain of the litigation contributed to the deterioration of his marriage, culminating in divorce proceedings. Given the legal findings of fiduciary breach and fraud, the division of marital assets was heavily influenced by the lawsuit's outcomes. Courts considered the professional misconduct when assessing equitable distribution, resulting in substantial asset awards favoring me. This personal collateral damage underscored the broader consequences of professional betrayal when it intersects with private life. Throughout this period, the $1.9 million property sale itself remained nullified. Court injunctions prevented any transfer of title or funds, preserving the asset within the partnership's estate, pending resolution. By maintaining ownership, I was able to safeguard the investment and prevent Douglas from profiting from an unauthorized transaction. This outcome was essential not only for financial recovery, but also for preserving the integrity of Cunningham Whitman Ventures' portfolio. The cumulative effect of these elements, the dissolution of the partnership, mounting legal fees, personal asset exposure, regulatory investigations, public scrutiny, and marital breakdown, constituted a comprehensive professional and personal collapse for Douglas. His actions, intended as a shortcut to resolve immediate liquidity issues, instead triggered a cascade that dismantled his career and financial standing. From my perspective, while the situation was professionally taxing, it validated the importance of the meticulous documentation and legal safeguards we had embedded from the outset. Each contractual clause, every notarized signature, the escrow instructions and the title insurance protocols formed an interlocking system that not only halted Douglas's unauthorized sale, but also enabled a systematic response that preserved our assets and reputation. This phase marked a transition from confrontation to control, turning the breach into an actionable framework for recovery and accountability. The rigorous enforcement of contractual and fiduciary standards, combined with legal and regulatory processes, ensured that Douglas faced the consequences of his misconduct comprehensively and proportionally. Yet, the situation remained dynamic. The partnership dissolution and legal battles were ongoing, with further negotiations, potential appeals, and asset recoveries still ahead. I remained vigilant and professionally engaged, aware that sustaining this course required continued discipline, strategic patience, and adherence to process. The collapse of Douglas's professional standing was severe, but not the end. It was a critical juncture in a broader narrative of restoring order and justice within Cunningham Whitman Ventures. The culmination of the legal proceedings marked a significant turning point, yet it was far from a simple victory. It was the result of methodical, evidence-driven litigation and strategic coordination with multiple parties. The court rulings awarded me $2.3 million in damages, which included the full $1.9 million value of the disputed property sale, plus additional penalties and costs intended to reflect the severity of Douglas's breach. Importantly, the judgment also covered attorney fees and associated litigation expenses, relieving the financial burden of the legal battle from Cunningham Whitman Ventures' operational accounts. This comprehensive award underscored the court's recognition of the forged sale as a serious violation of partnership obligations and fiduciary duty. From a procedural perspective, obtaining this judgment required meticulous presentation of the assembled evidence, notarized partnership agreements outlining the unanimous consent clause, a detailed chronology of unauthorized actions supported by time-stamped emails, and the forensic handwriting expert's conclusive report confirming the forgery. Each element was cross-referenced and verified, painting an incontrovertible picture of Douglas's unilateral and fraudulent conduct. The court's decision was grounded in this rigorous evidentiary framework that left little room for ambiguity or contestation. Simultaneously, the title insurance company honored its commitment and paid out claims related to the forged transaction, reinforcing the role that title insurance protocols play in protecting parties from fraud-related losses. Their payment was accompanied by formal notices of regulatory actions initiated against Douglas, including fines and sanctions for his fraudulent submission of closing documents. It was a clear message that regulatory bodies take such violations seriously, and that title insurers are vigilant partners in enforcing legal and ethical standards in real estate transactions. Douglas faced additional professional sanctions beyond the courtroom. The local real estate licensing board moved to revoke his licenses, citing violations of ethical and legal standards within the industry. This development not only restricted his ability to operate within the market, but also served as a public censure that further eroded his credibility. Being blacklisted by industry associations and losing access to key professional networks compounded his isolation, making future partnerships and projects exceedingly difficult to secure. On a contractual level, the court ruling mandated the full severance of Douglas's partnership interests in Cunningham Whitman Ventures. This included the transfer of intellectual property rights associated with proprietary deal pipelines and client lists that were central to the firm's ongoing operations. These assets were critical to preserving the company's competitive advantage and ensuring continuity under my sole leadership. The severance terms were crafted to preclude any residual claims or interference from Douglas, firmly delineating the post-litigation operational boundaries. The financial judgment and asset realignment attracted attention from new investors, many of whom were impressed by the strategic rigor and professionalism demonstrated throughout the dispute. My reputation for meticulous documentation, adherence to contractual discipline, and systematic legal recourse proved a compelling signal of stability and reliability in a market where partnership risks are often underappreciated. This influx of capital not only replenished working capital, but also facilitated expansion plans, including acquisition targets and enhanced project pipelines. Within the broader industry, the case became a reference point for addressing partnership fraud and enforcing fiduciary accountability. Peers and colleagues frequently sought my insights on best practices for contract management, partnership governance, and risk mitigation strategies. The litigation outcomes were cited in seminars and professional forums as a benchmark illustrating the consequences of unilateral misconduct and the efficacy of combining thorough documentation with advanced title insurance safeguards. This recognition reinforced my standing as a thought leader committed to integrity in commercial real estate. While the legal and financial victories were significant, they also served as a professional affirmation of the systems and processes I had championed over my career. The exhaustive notarization of agreements, the secure digital archiving of contracts, the insistence on dual consent provisions, and the collaboration with title insurers were not mere administrative formalities. They were strategic pillars that transformed a potentially devastating betrayal into a manageable, resolvable challenge. Despite the thoroughness of the judgment, this phase of resolution was in many ways a transition rather than an end point. The operational restructuring, investor relations, and ongoing regulatory oversight required sustained attention. Moreover, the legal framework established through this litigation set a precedent that would influence future partnership agreements and industry standards. I remained actively engaged in refining internal controls to prevent recurrence, leveraging lessons learned to enhance compliance training and audit processes within Cunningham Real Estate Group. In retrospect, the complex interplay between contractual rigor, forensic evidence, title insurance intervention, and judicial enforcement was decisive in dismantling Douglas's fraudulent sale and securing restitution. The case exemplified how professionalism, combined with strategic patience and meticulous documentation, can convert betrayal into an opportunity for organizational strengthening and reputational growth. As I continued to rebuild and expand, I understood that the true measure of success lay not solely in the monetary award or legal triumph, but in the reinforcement of a disciplined, transparent, and resilient business model. This model, grounded in enforceable agreements and supported by robust safeguards, ensured that Cunningham Real Estate Group would not only survive but thrive, setting a new standard for partnership accountability in the real estate sector. Today, I lead Cunningham Real Estate Group as a sole proprietor, having transitioned fully from the previous partnership structure. The company now generates approximately $18 million in annual revenue, a significant increase from the $12 million we managed as Cunningham Whitman Ventures. This growth has been driven not only by expanded investor networks, but also by an enhanced operational framework I implemented based on hard-earned lessons from the dispute with Douglas. The experience underscored the importance of uncompromising contractual discipline and the strategic value of comprehensive documentation in protecting assets and reputation. One immediate professional outcome was the restructuring of management and ownership. With Douglas removed from any operational or financial control, I gained full authority over all partnership assets, intellectual property, and proprietary deal pipelines. This consolidation allowed for streamlined decision-making and eliminated previous bottlenecks caused by shared governance. It also enabled me to introduce more rigorous compliance protocols and oversight mechanisms, reinforcing safeguards against unilateral actions that could jeopardize future transactions. Financially, my compensation increased by 35%, reflecting the expanded scope of responsibilities and the additional value created through these structural improvements. This adjustment was not merely a reward, but a necessary alignment of incentives with the heightened risks and managerial demands of sole proprietorship. The enhanced revenue streams and investor confidence justified this change, affirming that disciplined management and transparent governance are valued commodities in high-stakes real estate. The journey from partnership betrayal to sole ownership demanded more than just legal victories. It required a professional mindset committed to turning disruption into opportunity. I approached this with measured reflection, emphasizing the criticality of exhaustive documentation, precise contract language, and strategic patience. Every notarized agreement, every archived email, and every contractual clause played a role in constructing a framework robust enough to withstand internal and external challenges. This experience reinforced that in real estate investment, procedural rigor safeguards not just capital but professional integrity. Through this process, I have also strengthened relationships with investors and financial institutions. The manner in which the dispute was handled, with transparency, adherence to legal protocols, and systematic evidence presentation, instilled confidence that Cunningham Real Estate Group operates with the highest standards of professionalism. New investors were attracted by the firm's demonstrated resilience and commitment to due diligence, contributing capital that has expanded our acquisition capacity and pipeline development. Looking back, the ordeal reaffirmed a fundamental principle I have long held. Calm professionalism and legal rigor are paramount when navigating conflicts. Emotional reactions, however understandable, risk clouding judgment and undermining strategic positioning. Instead, I maintained a steady focus on procedural correctness and evidence-based advocacy, which proved decisive in safeguarding our interests. This disciplined approach transformed what could have been a crippling setback into a catalyst for organizational strengthening. Moreover, the experience has underscored the necessity of continuous improvement in contract and partnership management. I have invested in advanced digital archiving technologies, staff training programs emphasizing compliance, and regular internal audits designed to detect anomalies early. These measures ensure that Cunningham Real Estate Group remains vigilant against future risks, embedding a culture of accountability that permeates every level of operation. Professionally, I view this experience not only as a challenge overcome, but as a defining moment that validated my expertise and leadership. The capacity to navigate complex legal terrain, coordinate with forensic experts, engage regulatory bodies, and manage investor relations, all while maintaining operational stability, speaks to the multifaceted nature of managing high-value real estate ventures. This holistic competence is what distinguishes a successful managing partner from a transactional operator. In conclusion, the transition to leading Cunningham Real Estate Group as a sole proprietor, with enhanced revenues, expanded networks, and reinforced governance structures, exemplifies how strategic professionalism and unwavering adherence to contractual and legal frameworks can convert betrayal into opportunity. The systems I built and refined serve as both shield and foundation, demonstrating that in real estate, success is not just about deals closed, but about the integrity and rigor with which those deals are managed. The experience has made me a stronger, more resilient leader, dedicated to setting new standards in partnership accountability and operational excellence.